Joining us now, former Kansas City Fed President Thomas Hoenig. Great to have you on the show. Do want to get your thoughts on the comments we got from Chair Powell on Friday, because to me, the takeaway here is really not how much higher rates go, whether we get another 25 basis points or not. It's for how much longer they stay at these elevated levels.
Well, I think, first of all, yes, the chairman was careful, as you would expect. He didn't tip his hand at all. But I would say overall, he's cautious. And I think the FOMC is cautious about the economy. Number one, while it has slowed, it's stronger than people expected. The consumers have been stronger than they thought. And that gives them some pause. And they're committed. One thing he did reaffirm, he's committed to the 2% inflation target. So that does raise the issue of whether there'll be additional rate increases. My own view is, listening to him and a little bit of the chatter around it, there will be, unless there's a surprise, inflation surprise in September, it's just as likely they will pause as go forward and wait and see what might happen before their late October meeting and then decide. But if they have some upward movement in inflation, then I think they're more likely they will move. The other thing is, people are a little more concerned now for the longer run. That's getting more play at these kinds of meetings in terms of national debt and servicing debt and so forth, and what that effect will be on interest rates. So those are the combinations that are going to be affecting the discussions going forward, I think.
Yeah, we get a lot of data this week. We get PCE inflation reading, which we know is the Fed's preferred gauge. We get JOLTS. We get jobs report on Friday as well. If we continue to see resilient economic data here, does that signal that structurally the impact that these interest rate increases have had over the last 18 months is different than what we've seen in the past? Or is that we're still operating on these long and variable lags and we just haven't seen the full impacts yet?
Well, I think we've not seen the full impact yet. That clearly is not unusual for this stage of a tightening cycle. I would say that, number one. Number two, I think part of it, though, that has not been as much attention has been paid to is the fact that fiscal policy for the last 3 years has been enormously expansionary. I mean, you have several, not only the CARES Act, but then you have the Science and Chips Act. You have all these subsidy programs that are feeding the economy, and that's the an offsetting factor keeping the economy stronger than what people thought it might be.
You know, it's funny, just looking at Dallas Fed this morning and some of the survey comments. I mean, Dallas is always notoriously, I think, nervous. But one reads, the phone is not ringing. Our sales team is working harder with less results. Projects are being postponed. And perhaps even more telling, payments are increasingly protracted. Does that sound like the kind of commentary we should be getting at this point in the cycle?
Yes, I think so. We've been in this for a year and a half, and that's not dissimilar from past cycles. Now the slowing begins. We're seeing the pressure on long-term interest rates and the concerns about the debt. So uncertainty is growing, frankly. And that's part of the reason I think, depending on what the inflation numbers are in September, the Fed is as likely to pause as to go forward. The economy is slowing. Yes, we've had this pullback. I mean, we've had this upward push from strong consumer demand, but I think that's from past fiscal policy. And so, yes, we're going to be cautious. And I think we're right where we have been in the past. Things are now, I think, showing real slowdown in activity and concerns for the future.